Yeah, I'm losing my edge.
But yeah, I haven't been able to look at the platform. But last time I checked, our 30-year bond future, Pete, was up $1.25, came all the way back. I don't know where it rests right now, but in my mind, the 30-year product here, Pete, S30Y, which launched just 2 days ago.
Hard to believe. It's
great,
yeah.
Great for day trading, right?
Right. No, it's perfect because you know what? It's a dollar tick. It's 2 to 3 ticks wide. A lot of times it's 1 tick wide between the bid and the offer. And today's a great example of, we've been talking about this for a while. When will interest rates move? We're starting to see the semblance of rates in general move, yields move, and then different parts of the curve move in different fashion. So today's a great example. 3 days into it, contracts trading really nice volume, consistent liquidity, and the 30-year, and I think I heard you mention this, because they can go back and watch the archived YouTube piece, right?
Sure.
Because it was a great segment. Yep. And guys, do that. It's a great walkthrough. Sometimes I drag poor Frank all around the gymnasium trying to get a point across, and he's very crisp and concise when he does it. But a very interesting way to take advantage of the back and forth here we're seeing in the long end of the curve. That is what we call the whippier part of the curve. And just the takeaway there is traditionally more duration, 2 years versus 30 years. 30 years is more duration. It tends to have a little bit higher beta. That's really the takeaway.
No, yeah, I'm glad that you caught that, because that's an industry term that I caught from people like yourself when I joined the industry. And now, thankfully, with companies like the Small Exchange, the industry is everybody who's got a trading platform. And so now everybody will be saying this term whip. I've always been told, oh, the ZB future or the 30-year product, the classic bond, whatever you want to refer to it as, it's got more whip to it.
It's got a lot of whip.
That whip translates to the best day trading opportunity. And here's I like that you're entertaining yourself over there. And yeah, what Pete was referring to is the at the Small Exchange YouTube, the how to do futures trading the yield curve. That's the segment. It'll be archived soon. Go check out that. It's just a 30-minute straight shot of me, Frank, just one person monologuing the whole time about trading the yield curve. There's no divergent talking about buying glasses frames.
And the next week's YouTube segment is I want the whip. Is that what it's
is whip it? Yeah, next week we're gonna I'll karaoke whip it for everybody. But yeah, this 30-year product, Pete, the whip that goes along with the traditional ZB future or some the TLT or whatever, it's usually frustrating because you want that opportunity as a day trader. You want that greater volatility, Pete, but it usually comes packaged in a product that ZB futures right now sitting at more than $160,000 product. Okay, that's just too big. The TLT ETF margined like an ETF share, so you're paying either 50 or 100%. You're not getting efficient margin there. So it's been frustrating the everyday trader, just the everyday person in general, trying to find this day trading opportunity, find this whip, and you don't have a product that fits you. And we created this product right here, Pete. It's a $2,000 product in terms of its size. Initial margin right there of around $300 on a daily basis, moving about $50. Today we saw outlier move in bonds, and that was only as high as $120 to the upside. A great product structure, Pete, relative to ZB futures, TLT ETF shares to take advantage of that whip.
Absolutely, and that's what you want. You want a simple way to express an opinion. And we talked about this yesterday with the 5-year, the margin on that sitting at $50 and about $15 of daily move. There's the sort of the unique way to trade the product, which is yield, the world we live in, not the world we have to understand, which is a bond price. The ability to take 3 different points in time and trade those, and each one having all these benefits of simplicity. And I know we're both excited to talk about the term steepener and flattener, and then butterfly. All good things coming, but you're going to find that the good news is whatever we're doing, they're all one-to-one trades. They all quote and tick in the same way. So 3 terms on top of that are going to give you 7 different trading strategies, which is pretty darn cool.
Yeah, it's really cool what just these 3 icons here, these 3 different products can create. Yeah, like you said, Pete, the permutations out to like 7 different trades there. And you're talking about different sides of those different trades. You got more than 10 different sides of a different trade that you can take just with these 3 products, and they're all super interesting. But staying on the one product individually, what's really nice about this, Pete, is you get access to this long-term rate in something that looks like a rate. Like the move from $20 to $22 this morning to almost $23, Pete, it's just a matter of 2% to 2.2% to almost 2.3%. It's never have you been able to so quickly and easily access and understand this long-term interest rate. ZBs, it's always been like, oh, they got as high as 175. What does that mean? I don't know what that means. It's as arbitrary a price, Pete, as like, oh, S&P's almost got to 4,000. It's like that price means nothing. It's just it's literally just a number. Here, this $20, that's 2%, and the movement around that is all basis points and percentage points. Really easy to, for the first time, access this long-term interest rate.
Yeah, absolutely. And that's what you want, is simplicity in terms of an expression of opinion. You know, it's building consistent strategies and taking them out to see which ones work, which ones fit your methodology, and which one you can build mechanics around. Complexity around the product stops that process before it ever starts. So you want to get to the point we always, and you've coined this, it's a wonderful thing. Take your ideas to execution. Don't get stuck in a heavy lift of understanding what this means. Again, so all this has told me is, in a relatively quick amount of fashion since the beginning of the year, the 30-year bond rate has gone from 1.5% to 2%. That's a 25% move. It's a huge percentage move. But in terms of understanding what that means, in terms of the product we're trading, it's that simple. That's all it is. It's moved 55 basis points. Cool. That's $550. That's $550. It's as simple as that. Very interesting. The fact that we can break down what that movement is. And I like the fact you mentioned bringing up a bond chart, and we traded briefly below 160 in the ZB today. We started out the year closer to 172, I want to say. Frankie, you and I both would have to say, number one, we don't know what that yield is specifically, basis those two extremes, nor it would take us some time to sit down and figure out the math behind that move. There is, if you can explain, and we always say, if you can explain the product in 3 sentences, you've built a good product. I think this is an example of, you can explain exactly what it is in 3 sentences and what that movement means. It's pretty straightforward and pretty powerful in terms of the amount of movement you get.
Absolutely. Yeah, those two things there, the size of the product, like we led with, and the simplicity that you see here, like Pete was saying, 172 at the start of the year down to 160 now in that ZB. Don't know what that means, but you look at the start of the year right here at $17, that's 1.7%. Right now at $22, that's 2.2%. Both of those things making it very easy for you to take ideas to execution, small size, simple structure. And now let's get into what we mean by the whip, because you alluded to it a little bit on the front end of the segment here, right. But maybe dive deeper into this little chart that I mocked up. When you add time, you go from just 1 day out, 30-day Treasury bills, something that we don't have products for yet at the small exchange, to a 2-year, to a 10-year, to a 30-year. As you add time and an interest rate, Pete, you, for lack of a better term, you add volatility, you add that whip, right? Right.
And, it's, I don't want to go down the rabbit hole of economic theory, but there's more uncertainty when you price an event that has 30 years to transpire versus one that has 2 years. So is it always the case that the long end moves more than the short end? S30 moves more than S2? No, not always. But when you look at it historically and say with about 85% certainty, you're going to see greater movement in the longer end of the curve than the shorter end. It's just a function of the uncertainty of time. So the market prices in that uncertainty by more elasticity. So you just get more back and forth on the longer dated product.
That's a great, simple explanation there. I always reference this, Pete, and as far back as you and I go in our relationship here on the network, I've always talked about the fact that, like, if you're trading a euro dollar that expires this year, or you're trading the 2-year, or you're trading the 5-year or the 10-year, there's only X amount of Fed events and non-farm payroll,
right?
And these different events that pop up every month or so in that interest rate. When you get out to the 30-year, that's 30 years worth of 10 Fed meetings per year. So that's 300 Fed meetings between now and then. That's non-farms every month. 12 times a year for 30 years, adding all those events into that yield means exactly what you just said. More elasticity, more back and forth, more whip, and more, and that almost always translates to me, Pete, more opportunity for the day trader, because you look at these ranges here, and it's interesting because we don't take bets on, but we always kind of joke about, whenever we launch products, it's like, which one do you think is going to be the most interesting? And I am 0 for 8 at this point. Do we have 8 products? 0 for 7 here at this point, because I'm always wrong with this. It's like we initially launched and it's like, oh, I think the stock products are going to be really interesting. People love the metals and the dollar. We launched these yield products and I'm like, oh, people are going to love this 30-year because it whips around a ton and it's got this daily range that's 50 cents or $50. And that's, what we're advocating for here today is day trading that product, because how do you day trade S2Y? And that's why going into this, I was like, I don't know if too many people are going to trade this S2Y, because you can't day trade, 15 cents or $15. Even us, the smallest traders, can't really make with such low fees at the small exchange, can't really make a case, Pete, for scalping inside a $15 range. It's tough. But what's funny is that S2Y is seeing some of the most interest because a lot of people like placing longer term bets on where short term rates are going. But this S30Y I think is really intriguing for what I thought going into the launch, which is it moves around more. It's got a larger range, which is still only about $50 worth of range. And that is what day traders seek, Pete. They seek volatility and opportunity might as well be the same words for day traders.
Yeah, absolutely. And, it's funny because you and I both are thinking when we put these twos on, we know that the twos, especially over the last 4 years, have not really moved. They've been anchored towards where the Fed has set rates for the most part, down at that lower bound. But we also felt, having lived through several interest rate cycles, that when the Fed becomes unhinged, and I don't mean unhinged, but the market challenges their assumption, what they want to do, the twos will become an incredibly interesting part of that 10s and 30s. And you'll see convergence, divergence. That is that new set of opportunities. But when you think about it too, when you're building futures for a new generation of traders and a new audience of traders, a product that requires only $50 a margin, but still moves $15 a day with 15 unique price points. Now it's interesting because Eurodollar futures, which you and I have traded tens of thousands of, they're incredibly liquid. They don't move. Now they move $12.50 a day, but so you think same thing. Well, that's one tick though. There's only one price point that trades during the day, the bid and the offer. There's no opportunity in trading that during the day. When you have a small enough product like this, even though it's only $50 and it can move $15, which we all agree, well, that's not a huge amount. I can, that's buying you and your roommate a salad.
I could buy a lot of glasses for glasses frames.
You could trade hundreds of thousands of these contracts for what you spent on glasses, knucklehead. But that ability to trade 15 unique price points is incredibly powerful. So yes, the nature of being to trade these different slices, depending on where you want to position yourself and I don't think it's necessarily, you can grow from trading twos to trading 10s to trading 30s. I think a lot of us started our career trading probably too much duration and getting whipped apart. A lot of times when you say the whip, I think whenever a trader says, hey, those 30s have more whip, it's not because we're saying, hey, come play. This is a better playground. It's just be mindful. They've got more whip.
Awesome is that the playground here at the small exchange, though, Pete, the products are so small and manageable that whip goes from being a negative thing to a positive thing. Like,
absolutely.
Look at yesterday's opportunity here in S30Y in white relative to S2Y. And you see here, they're cut from the same cloth. They're the same product, different durations here. And so they move similar. But what you've got here is so many more unique price points, which Pete just advocated for. The S2Y does do better than, ZT futures or GE, the Eurodollar futures there in terms of price points. But the S30Y does better than S2Y and S10Y. And that's what day traders are looking at here is just getting as many unique prices in here. And we just saw this the first day of trading on Monday, a low of $21.20, high of $21.80, and then it settled right in there about $21.65 or wherever. Pete, That's a 60-cent range there, moved lower, almost down to $21, got all the way up to almost $22, and then came back. A great active market in here where that whip, like we've been talking about, is a good thing and not a negative thing like it has been in the past because the products are too big and they're too complex. Small bond trading here at the small exchange makes that whip and that activity a positive thing for the active trader.